Without question, Warren Buffett and the rest of Berkshire Hathaway's investment team incorporate many different metrics when evaluating prospective companies to acquire and stocks to buy. However, Warren Buffett himself has mentioned one specific metric as the best indicator of stock valuations, and it has appropriately been nicknamed the Buffett indicator. So let's take another look at the Buffett indicator and see why it might be signaling that the stock market is just a bit overheated. Let's take a look. The Buffett indicator is a metric that Warren Buffett uses to get an overall feel for the valuation of U.S. stocks. In fact, he described it as the best single measure of where valuations stand at any given moment in a 2001 interview with Fortune magazine. It's a fairly simple metric to calculate. Just divide the total market capitalization of all U.S. stocks by the latest gross domestic product, or the GDP. To be clear, no stock market metrics are 100% reliable at predicting corrections, crashes, rallies, or stagnant stock markets. After all, if this were the case, wouldn't everyone know exactly when to buy, sell, and hold in order to maximize their profits? That being said, the Buffett indicator, while it's not a flawless indicator, does tend to peak during hot stock markets and bottom during weak markets. And as a general rule, if the indicator falls below 80 to 90% or so, it has historically signaled that stocks are cheap. On the other hand, levels significantly higher than 100% can indicate stocks are expensive. For context, the Buffett indicator peaked at about 145% right before the dot-com bubble burst and reached just about 110% right before the Great Financial Crisis. There are two big caveats to realize. First, just because the Buffett indicator signals that stocks are cheap doesn't mean that they won't get even cheaper. And as we'll see in the chart coming up, the Buffett indicator didn't bottom out during the financial crisis until it was briefly below 50%. Conversely, just because the Buffett indicator looks expensive, as it does now, doesn't mean that stocks can't continue to go higher. In a nutshell, the Buffett indicator can tell you the valuation of the stock market in a historical context. It doesn't necessarily predict tops or bottoms. So let's take a look at what the Buffett indicator is saying now. And this chart here from Advisor Perspective shows the Buffett indicator based on corporate equities to GDP. And understand there are other variations out there. We're going to take a look at a second variation here relatively soon. But this chart here shows that we're currently at 132.7, or at least back in July. We might be a little bit higher now. But back when this was produced, we were at 132.7, and the second highest level, relatively speaking, compared to the level right before the dot-com bubble at 151.3. Another variation of this chart out there indicates that we're even higher than we were right before the dot-com bubble, but it doesn't really matter. We're at the highest or the second highest. We are at a relative elevated level. And so there's some good reasons for these high valuations, and include lower corporate taxes, the generally business-friendly administration, prolonged historically low interest rates, low unemployment rates, relatively high consumer confidence, and the generally good corporate earnings that have been coming out. Given the fact that the Buffett indicator doesn't take some of these things into account, is perhaps one of its biggest flaws. So, for example, if you look at the stock market during a high interest rate period and a low interest rate period, examining the stock valuations under those two scenarios isn't necessarily an apples to apples comparison. However, having said that, it does seem like Warren Buffett himself is paying attention and agrees that the market is generally expensive. After all, the lack of attractive investment opportunities has resulted in Berkshire Hathaway accumulating over $110 billion of cash on its balance sheet. Plus, Warren Buffett has specifically cited valuation when he's discussed the absence of major acquisitions. And he hasn't made any major acquisitions in the last couple of years. He's added to some of his holdings, including Apple stock, but he hasn't made any major acquisitions, say, in the last couple of years. So let's go take a look at another variation of this chart. And again, from advisor perspectives, this chart here is the Buffett indicator, and it's using the Wilshire 5000 to GDP. The Wilshire 5000 probably throws out a wider net of corporations. So this actually may be a better variation than the one that we just looked at. And as I had indicated, perhaps this is what others are pointing to when they say that the current valuation, this shows 142.0, is higher than the measure right before the dot-com bubble there at 136.5%. So, as you can see, no matter which way you look at it, we are at a relative high. This chart here goes back to 1970. The previous chart went back to 1950. So whether you're looking at 40, 50, 60 years or so, we are at elevated levels. So it's just time to be cautious. And this last chart here, again, from advisor perspectives, shows the Buffett indicator, the corporate equities to GDP, which is the first chart we looked at, superimposed with the S&P 500 based on a logarithmic scale. And so to sum it up, while the Buffett indicator is certainly a great snapshot of stock valuations, it's not a standalone metric that you should use necessarily to determine when to buy or sell. It's not a timing indicator per se. But when Warren Buffett was asked about the indicator, and another favorite metric at Berkshire's 2017 annual meeting, Buffett said that, I quote, "It's just not quite as simple as having one or two formulas and then saying the market is undervalued or overvalued." So this just is another tool here. It's an interesting tool. But with that in mind, the fact is that Warren Buffett, the indicator, is at its highest point or nearly its highest point, depending upon what chart you look at, meaning that stocks have not been this high in a long time in terms of the GDP. So while this indicator doesn't necessarily mean that the tides will turn anytime in the near future, it may be a smart idea to start thinking a little defensively and don't get caught on that razor wire. So once again, more caution signs out there. I don't want to be a nervous Nelly here. I don't want to be always bearish. So we like to look at these indicators, and I'll come up with others. This is just one that tells us that, look, we need to be a little bit cautious. And certainly this previous week in trading in the market shows that there's a lot of nervousness out there. And that's when you can make some mistakes and lose a lot of money, and that we don't want to do. So for today, that's ChewDog Charts. Thank you.